Hey guys, Richard Matthews with Matthews Wealth Management. We're going to talk about mutual funds today. I know we've all heard about mutual funds. We have them in our 401ks, we have them in our IRAs, brokerage accounts. They're talked about on the TV, on the radio, even probably with your friends. But what exactly is a mutual fund? We're going to go through a demonstration here to kind of understand the ins and outs of how a mutual fund works, how it's funded, how it's invested, just so that we can all be on the same page with mutual funds. So what we have here in this demonstration is we have three separate investors. We have the red, the white, and the blue. We're being pretty patriotic today, but each of these investors here represents $40 worth of investing. This is going to be our actual fund. So we're going to invest into our fund here. So before we do that though, we have to talk about types of funds. They're structured differently. They have different fee structures. So you may hear about A shares, Y shares, I shares, etc. We're going to cover all of that, but in our example here, let's talk about an A share. So an A share has a front-end load. So it's a percentage that you have to pay off the top just to be able to invest into the fund. So in our example here for our investor represented by red, we have $40, and what we're going to do is take 5% off the top. So we've got two of these dollars, and that is a load, and we're going to represent that to the side. So where does the load go? The load is actually the commission that is paid to your broker who's selling you this mutual fund. So off the top, it goes to pay basically his fees for putting you into one of these funds. So that's money that doesn't get invested. It just comes straight off the top. There's an additional piece of fee that happens on a year-to-year basis, and that fee goes to the mutual fund company and the manager. We'll talk a little bit about that when we come back. But let's go ahead and take our load out of the white investment as well as the blue. So now we've got $38 in each of these investors' pools of money, and we're going to go ahead and fund our mutual fund. So let's go ahead and invest. And the next piece of the puzzle here is we have to determine what it is that your dollars are going to be invested into. So that's where we talk about the investment objective of the mutual fund. So here we go, we've funded it mutually. We've got a number of dollars in here. And whether we invest this into the stock market, money market, bonds, real estate, those are different investment objectives. So when you're investing into a mutual fund, it's important to understand what the purpose of the investment is. So it's something that we need to look into, because as we invest into that, we will mutually experience the same gains and losses as the other investors. So we're going to leave this alone, let it grow for a while, and come back and talk a little bit more about what happens year to year. All right, we're back. We've got our mutual fund here. It looks like it's done a really good job of growing. What we've done hypothetically is, let's say we're coming back 10 years later. We've averaged 7.2% rate of return, which equals doubling our money in that 10-year span. So over here though, if we notice, we've got another pile that's accumulated outside of our mutual fund. That's the same pile that represented the fees that were taken out from our upfront investment. So we have another piece of fees that is accumulating in our pile here that represents an annual expense ratio. And so what that includes is it's paying an investment advisor to purchase stocks and bonds and real estate and different underlying securities. It also represents an administrative fee that comes out to pay for marketing material that they'll use to get new clients and new investments. It covers the auditing and the record keeping. And so that's roughly 1% in our example that we're taking off the top year after year after year. So you really can see how they add up together and how they pile up to be a pretty substantial piece of the puzzle. So we're going to talk next about the types of share classes inside of mutual funds and how you can be smart about choosing the fees that you would like to pay. All right guys, we're back. I've got a stack of prospectuses, some semi-annual reports. This stuff tends to come in pretty frequently at our firm here. So what I wanted to do was give an actual example of a mutual fund like we just went through on our hypothetical here, just to illustrate exactly what different types of mutual funds look like in terms of fees. So right now we're looking at Davis Funds and their New York Venture Fund. And if you turn to page 4, actually, it's not that deep into the actual report, you'll get a graph here and a chart that lays out all of the different share classes and then the fees associated with them. So I'm going to write those up here real quick and we'll just do an overview of the Davis New York Venture Fund. So the first thing we're going to look at is share classes. We have A shares, we have B shares, C shares, it's making a lot of sense, right? Then we go to R shares and then class Y, all right? So the two areas that we talked about before in our illustration were the front end load, where they would take the money off the top of your investment. So let's look at what load is associated with each one of these share classes. So first area is the A share. And if you look on their chart here, the class A share has a 4.75% charge. So when we took the $2 off of each of these investments up front, that was associated with a 5% load, which is about an industry average. This is a little lower than average, which is good. You see them go as high as 5.75, but in this case, their A share is 4.75. You look at their B share, there is no front load. Same with the C, same with the R, and same with the Y. So that's looking pretty straightforward as far as which ones we want to look towards and the ones we want to avoid. However, now we're going to get into what the annual expense on each of these funds looks like. So for the A share, we have a 0.90% fee. And now that's going to come off of the top, whether that's gains or principal. These fees come out whether you're making money or losing money. So 4.75 up front, 0.9 year over year, which is a great representation of what we've done in a hypothetical 10-year scenario in our illustration. B share classes, we have a 1.93%. That's a lot of money. 1.93 is, if you've had this for 10 years, you've paid a lot more than the A share here. So you can see by paying some up front, it makes it cheaper over time. By paying nothing up front, you pay a lot more over time. The C share that we look at is a 1.69%. So a little bit cheaper than the B. There's some more details about B shares we're not going to cover in this video, but you're starting to see at least there's a trade-off. They're going to get their fee one way or another. Now we get to R shares. So a class R share is 1.18% per year. And then the Y share that we're looking at is 0.64% per year. So if we just look at these 5 share classes, we see the A, B, and C are significantly higher than the R and the Y. We refer to the A, B, and C as retail shares. That's a financial advisor you meet off the street. These are institutional share classes. So there's no difference at all in the New York Venture Fund as far as investments. You're buying the exact same underlying securities, getting the exact same rate of return. They're taking very different fees out of your investment up front and over time. So it makes a lot of sense to start looking for the Y and start avoiding the A, B's, and C shares. So come back to us next time and we look forward to seeing you.